I want to bring in my Euro trade weighted charts. This is a classic Bloomberg chart, which we do on Bloomberg Surveillance, which also strips away some of the other dynamics. For example, dollar. Euro area inflation hit the fastest pace in more than a year. Now, that means it could be good news for the ECB officials debating on the future of policy and whether they want to at least give the market a kind of timing for normalization. But how much does Italy complicate everything? So this may not actually, this may actually make their lives much more difficult.
On the inflation data, we know there's oil base effects. Underlying inflation is just above 1%. Our forecast is for underlying inflation to stay just above 1%. So depending on how serious they are about close to 2% objective, they're still a long way below that. I think in terms of Italy and complications there, I mean, clearly, we think you need to be careful on assets which rely heavily on central bank support. One of our themes in our secular outlook, be careful about assets which rely heavily on central bank support. In the case of the peripherals in Europe, the end of QE tightening in terms of policy rates over time is going to be a challenge and a hurdle. But I think at the moment, the politics, having two populist parties, such an unusual combination coming together. The fact that in their first draft they talked about Euro exit, and in their second draft they said, "Oh, don't worry, we've taken that out," is kind of charming. But in terms of the stability of the Italian political system and Euro exit risk, they really are publicising this risk very well at the moment.
Stephen, very quickly, if you look at inflation, I mean, this is kind of what Mario Draghi has been waiting for, right? So that gives him the, ammunition to then hint at asset purchases normalization. But is it risky doing it now with Italy?
Well, I think just on the inflation number, the headline is attention-grabbing, but the core inflation rate is only moving up very, very gradually. And I would have thought that the ECB paid more attention to that. In terms of the political risk, I would have thought that they look much more at credit numbers and underlying characteristics within inflation, wage inflation, productivity growth, the asset utilisation by firms, rather than attempting to head off political risk. I think they'll wait and see how markets settle. But I would have thought the credit numbers are way more important than anything that's going on in the Quirinal Palace.